Thank you very much, Fred. Not only would I maybe have named the Washington Consensus something different, I don't think I would have made fundamental equilibrium exchange rates into an acronym if I'd known the mirth that was going to surround this term from then on, such as the comments that you have nothing to fear but fears themselves. I want to start, as Fred okay. Sorry for these teething problems. As Fred has said, we don't here at the Institute dismiss this search for equilibrium exchange rates. We actually think it's quite an important topic and that one can meaningfully talk about an equilibrium exchange rate. But of course there are different concepts of equilibrium. We know that, and it's important to be clear as to which one is searching for. We think of it as an underlying rate that's consistent with medium-run macroeconomic equilibrium. It's medium run in the sense that one doesn't require the debt stocks to be constant, but other things should be essentially constant and or expanding in line with the economy. So that's the rate consistent with achieving specific macroeconomic objectives. They have to be sustainable objectives. And if there are some ambiguities, as there usually are when one has this definition of this sort, then one resolves them in the way that's customary to economists by appealing to utility maximization. Now clearly here one is talking about a real exchange rate, that's to say an inflation-adjusted exchange rate. One is talking about an effective exchange rate, one that is average trade-weighted exchange rate rather than a rate against a particular currency. So that's taken for granted. The determinant of a fundamental equilibrium exchange rate, these determinants fall in two classes. First of all, there are assumptions about what the world would be like in the absence of policy changes, notably changes of exchange rates. And then there are assumptions about the pattern of desirable outcomes, and then one is searching for the exchange rate which will be consistent with moving the actual predicted outcome to the desired outcome. We use the April 2008 World Economic Outlook in order to specify likely outcomes on the basis of present policies. We don't imagine that the IMF got absolutely everything right, but we don't see a lot of evidence there that there is a great deal wrong with using the shorter run forecasts for 2009, which are the presumably somewhat more solidly based than the forecasts for 2013. But the big reason is that for using these shorter run ones is that there really isn't a big change in the IMF forecasts. Apart from Russia, which anyway we really don't try to forecast, try to look at it for its fundamental equilibrium exchange rate because it's a big oil exporter nowadays. Apart from Russia, the forecasts for the year 2013 look pretty much like those for the year 2009, and that's why we figured on using the 2009 figures. Now, since April, when the IMF published World Economic Outlook, there has been a rise in the oil price of over 40%. We know that. We essentially are not going to try and forecast the exchange or forecast to, we're not trying to calculate the fundamental equilibrium exchange rates of the oil exporters. And then there's an implicit assumption that the relative exchange rates of the oil importing countries won't be enormously sensitive to variations in the oil price. that's implicit in what we have done. But there has been this big increase in the oil price, and we're well aware of it, but there's not, unless we've tried to, well, to try and update the forecasts every time that there was a change in the oil price would simply not have been feasible. If you apply these rules, the rules that we suggested were first of all, we assume that actually we believe it to be true that the critical determinant of the equilibrium exchange rates is in fact the current balance target that is aimed at. Now, that wasn't necessarily always true in the past, because there was also a measure of flexibility about how how one interpreted the concept of internal balance. But essentially, we're all accelerationists these days. We all believe that if you hold the pressure of demand too high, then there's a permanent acceleration of inflation, and that's just not feasible. And if you hold the pressure of demand below this natural rate, then one gets a deflation setting in. And so that really removes macroeconomic policy as a policy tool, or one to influence that's capable of changing the level of internal demand greatly. The other thing that used to be used in the early post-war years was trade policy, and that also has fallen into disuse, and for, we think, much better reasons, that there are much better things to do with trade policy than use it as a tool of macroeconomic policy. And so that essentially says that it's the current balance target which determines the equilibrium exchange rate. So we look at equilibrium current balance targets. We suggest that they ought normally to be limited to 3% of GDP. There are a handful of countries, we identified 4, where maybe one has to appropriately go to a higher level of current imbalance, but usually it should be limited to 3% of GDP. Why 3%? Well, first reason is that that's the same figure that everybody else uses, and we don't want any people to jump down our throats saying that we achieved our results because of using a different figure to everybody else. And the second reason is that there is at least a modicum of statistical support for thinking that a 3% deficit is about the limit of what's prudent on a long-term basis. And then if you want to have a symmetrical world, you have to have a 3% limit on surplus as well. So that's the basis of the 3%. Second assumption is that capital should flow downhill from developed to developing countries rather than uphill from developing countries to developed. Then apart from these few countries, which I mention in the next bullets there, Australia, New Zealand, deficits and surpluses, Singapore and Switzerland, where 6% seemed a reasonable limit. And we didn't estimate targets for the oil exports in the central case because those depend on changes in the oil price, which we didn't feel we were in a position to forecast sensibly, and the saving strategies of the oil exporters, which vary enormously, and which again one has to be a specialist to get sensible figures for that. So we really didn't make up figures for those countries. If you apply those preceding rules, then that gives you targets, current balance targets for 24 economies. We altogether were, we had 34 economies identified in the study. So that deals with 24 of them. and then there are the oil exporters. So remaining countries, there are 6 that remain, and they are all big surplus countries. They're all high surplus economies at the present time, with a collective surplus of $430 billion. These other countries, these 24, would have an aggregate deficit reduction applying the preceding rules of $351 billion. So we simply took the target for the remaining countries as being 351 over 430 times the excess of each of these countries' projected surplus over 3% of GDP. So as you can see, in this next slide, that involves a country like China, which on the crude interpretation, if we were simply allowing it a target surplus of 3% of GDP, in fact, there would then be a need for a 7% of GDP adjustment, but because it's only 351 4/30ths of the adjustment takes place, its actual target adjustment is going to be 5.7% of GDP. Right? So we derived in the same way the targets for all the other countries. There were 6 countries in this category of what were major 6 economies, I should say, because they include Taiwan and Hong Kong, which some people at least don't regard as countries. There were 6 economies which were surplus economies, which were treated in this way. And the other countries were treated as I've described. In that way, we got targets for all of the major countries, and we then subjected them to a treatment which Bill will describe in a moment. Let me just mention first, however, that we did do some variant simulations. First of all, we had the same current account targets, but higher trade elasticities. That was done because in order to shrink the global current account discrepancy. And then we had a simulation in which we treated the oil exporters in the same way as the other countries. Basically, Russia and Venezuela anyway are not caught by this because they're within the 3% limit, but the other 2 countries have to make very big cuts in their surpluses, and in consequence they both had very high appreciations required. And then the final simulation that we ran was an attempt to apply what's described in the IMF as the third method. The first one, it being essentially our approach, but there are 2 variations, but that is a macroeconomic balance approach. And the second one being a beer-like approach. And then finally, there's this one where you aim to keep the ratio of net foreign assets to GDP constant over time. So we chose to stabilize it at the 2009 level, and that is a good bit more demanding of adjustment by certain countries, including the United States and China, and clearly Australia, which then has to make a big adjustment down of its current account deficit. So let me at this point hand over to Bill to describe the next part of the study.
Thank you, John. First, I'd like to thank Tom Emmons and Claire Brunel for research assistance on the project. The working paper that is in the handout that you have shows the model that I've developed to translate these targets for changes in current account into corresponding changes in real effective exchange rates and in bilateral exchange rates against the dollar. I call the model the symmetric matrix inversion method, or SMIM model, It's symmetric in that it gives equal weights to all the major countries instead of giving exclusive attention to the United States meeting exact target and then treating the other countries as residual. The approach basically makes two calculations. The first is to take a set of current account change targets and to calculate the needed changes in real effective exchange rates to bring about these changes. Now, this is basically an empirical matter that depends on the elasticity of exports and imports with respect to price and on the size of the trade sector in the economy. Implicitly, this approach assumes that there are parallel changes in the absorption parts of the elasticities and absorption general equilibrium system, if you will. The price effect on trade on the one hand, and the income effects, I minus S, investment minus savings balance on the other. So that's sort of in the background. So you first then calculate the change in the real effective exchange rate needed to get the change in the current account. And secondly, given a desired set of changes in real effective exchange rates, the approach applies a matrix method to ensure that all the country's changes in effective exchange rates are consistent with each other, and to ensure that the corresponding changes in bilateral exchange rates against the dollar are consistent with the changes in effective exchange rates. The impact of a change in the real effective exchange rate is calculated using a summary impact parameter. In the United States, a 1% rise in the dollar causes a 0.16% deterioration in the current account balance. For the United States, as opposed to all the other countries, I derived this from the model that I developed in my 2005 book. In China, this parameter is 0.3. So if you wanted to reduce the current account deficit by 5.7% in China of GDP, the real effective exchange rate would need to rise by 19%. These impact parameters are based on the price elasticity of exports on the one hand and the size of exports in GDP relative to GDP on the other. I focus on exports because the import price elasticity is typically thought to be about unity, and with a unitary import price elasticity, the local currency value of imports will not change because the price effect offsets the quantity effect. So we focus on exports. And I assume that the price elasticity of exports starts out at unity for a fairly closed economy and descends to something like 0.5 for an economy with exports of 100% of GDP, basically because of increasing supply constraints as exports become much larger relative to the productive capacity. The impact parameter then is a product of the export price elasticity and the share of exports in GDP, and that's where you get this impact parameter pattern here. And I do have a high elasticity case, which gives you a larger impact parameter, which I'll come back to. In that case, it's assumed that the price elasticity of exports starts out at 0.75. I'm sorry, it starts out at 1.5 and goes down to 0.75. Okay, so what real exchange rate changes do you need? Well, it's just a simple question of taking the target change in the current account as a percent of GDP, dividing it by this impact parameter. Perhaps best illustrated by Singapore, the biggest of the whole set. The target is a reduction of the current account by 13% of GDP. The impact parameter is 0.5% of GDP for each 1% rise in real effective exchange rate, so you need about a 26% effective appreciation. Now, the next step is to identify what's happening to the country's effective exchange rate when not only its currency moves, but when all the other currencies are also moving at the same time. The key here is that if the country were to have its currency be the only one that moved, then its change in its effective exchange rate would be identical to its change in its bilateral exchange rate against the dollar. But if all currencies are moving against the dollar, then the country's bilateral move will be offset to some extent when it comes to the effective rate by the changes in the partner currencies against the dollar. So the effective rate of a country rises by the country's bilateral appreciation minus the appreciations of its partner countries' currencies against the dollar, weighted by its trade with those partners. In this slide, the calculation is done for country K, and in the middle of this bottom equation, you'll see that there's just a plus Z sub K. Well, let's say that the country appreciates by 10%, then Z sub K will be plus 10%. But then you've got all these minus contributions here. Let's say its first trading partner goes up by 5%. Well, you've got minus 5% times the weight of that country, etc. Now, in a full set of equations, you'd have one of these equations for each country, and this would be sort of the kth country. Well, when you start working with a system like that, the natural way to deal with it is to use matrix algebra. I thought that at this point a bit of visual no-dos might help. The set of real effective exchange rate changes is a vector, R. The set of changes in the bilateral exchange rates against the dollar is a vector, Z. And R is going to equal Z multiplied by a matrix that has negatively signed partner trade weights for all the bilateral changes of the partners' exchange rates, and simply has a 1 for the country in question. This turns out to be the identity matrix minus the trade share matrix. You solve then for the set of bilateral exchange rate changes by essentially dividing both sides of that previous equation by that matrix B, and then that means multiplying by the inverse of matrix B. So you multiply the vector of desired real effective exchange rate changes by the inverse of this B matrix, and that gives you the set of desired changes in the bilateral exchange rates against the dollar. Now, this system turns out to be overdetermined. We have 35 countries here, and we've only got 34 unknowns. One exchange rate is known, that's the dollar. It's unity by definition. Well, in that kind of a system, you're going to have just as many possible solutions as there are countries. It's 35 possible solutions. So what I do is to simply take the average of all of those possible solutions to get our estimate, with one exception, which I won't go into detail too much, but it's the average of the 34 cases in which the country in question is included as exchange rate, because every time you do one of the cases, you have to leave out one country. Now, because the overall estimate is an averaging compromise, it will not be likely that you will get exactly the target real effective exchange rate change for any individual country that you are seeking. It turns out, however, that the estimates are all quite close to the targets. John mentioned the variance that we included. The high elasticity case is included because if we just apply the standard elasticities, we wind up with a fairly large global current account discrepancy, and that may reflect the fact that I'm using an impact parameter that's from a specific model for the United States, but on the other side, it's sort of the standardized relationship. So perhaps that standardized relationship is understated, and when we use the high elasticities, we shrink the global discrepancy that arises The oil adjustment, John has talked about that. And the other variant, the net foreign assets variant, is accomplished by basically asking what current account would stabilize the net foreign assets. It turns out there's a very nice little rule of thumb, which is to stabilize at the current ratio of net foreign assets to GDP. Let's say that's 50%. You want the current account as a percent of GDP divided by the nominal growth rate of GDP to equal that ratio. So that's how you get that current account. It basically stems from the fact that the current account is a change in net foreign assets at the margin. The nominal growth rate applied to GDP is the change in the GDP at the margin, one in the numerator, one in the denominator. And for anything to stabilize, the margin should equal the average. So that's the way you get that relationship. I will point out that in this particular variant in the paper, we do not apply it to the oil countries. So once again, for all except one of our variants, the oil countries are exceptions. So to recapitulate, the model takes the current account targets from John's or someone else's equilibrium principles. It uses impact parameters to find out how large the effective exchange rate change needs to be to achieve these changes. And then it uses a matrix inversion method that involves trade weights to do two things. First, to ensure that the desired changes in effective exchange rates are met as closely as possible while being consistent with each other. And second, to identify the changes in the bilateral exchange rates against the dollar that will be consistent with a set of effective exchange rate changes estimated. So let me turn it back to John for the results.
Well, thank you, Bill. Let me just spend a moment or two talking about the results that we got as a result of this procedure. Of course, we were using the figures of 2009, but we don't really imagine that adjustment will be completed in 2009, and that's not implicit. One has to use some figure in order to, one knows perfectly well that adjustment is going to take longer than a year, but one has to base it on something, and so 2009 was the figure. The procedure was that Bill has just described. We started off by estimating needed changes in effective exchange rates by dividing target changes in the current balance by the impact parameters. And then we applied the symmetric matrix inversion model in order to get the bilateral rates against the dollar that would more or less achieve this set of effective exchange rates. And positive numbers here indicate undervaluations, so there's a need to appreciate the exchange rate. These are the results that we got for the major countries. The full set of countries is in fact given in your outline, but not with as up-to-date figures as we have here in the final column. But we felt that it was more interesting to try and to focus for a limited number of countries on recent changes. So, for example, in Canada, we concluded that its trade-weighted average exchange rate was overvalued by 4.1% in February of this year, which is when these calculations relate to. And that's translated into a bilateral overvaluation vis-a-vis the US dollar of simply 1.6%, only 1.6%, and or an equivalent exchange rate of 1.02 Canadian dollars equals 1 US dollar. So the Canadian dollar is slightly below parity in this calculation, and it was even more slightly below parity in the first half of July, and therefore the Canadian dollar could do with a very, very small depreciation vis-a-vis the US dollar in the first half of July. We did the same sort of calculation for all of these countries here. And in the euro area, you can see we concluded that it was substantially overvalued on an effective basis, but not in February vis-a-vis the dollar. But by July, it was overvalued vis-a-vis the dollar as well by 7%. Japan, on the other hand, is undervalued. It's the undervaluation there is calculated as 19% on an effective basis in February and 18% against the dollar just recently. Switzerland was the most undervalued currency on an effective basis, but a very similar bilateral appreciation against the dollar, and a much smaller one than some of the other Asian countries, and so on. You'll see that our conclusion was that in February the dollar was still overvalued by nearly 9%. That since then it has fallen further, but we would still have it somewhat overvalued at the present time. But this is entirely, more than entirely, accounted for by the Asian currencies, in particular China, Japan, Malaysia, Singapore, Taiwan, Hong Kong, rather than overvaluation vis-a-vis Europe and Europe in general, other than Switzerland and Sweden, but where the euro, vis-a-vis the euro, vis-a-vis the pound, vis-a-vis also the Canadian dollar and the Australian dollar, the adjustment has essentially happened at this stage, or maybe there's even some sign of an overshooting having occurred there. If I just go on, the main results that were shown in the previous paper was the dollar is still overvalued, but this is only with respect to the Asian currencies, and plus Switzerland, Sweden, maybe there's somebody else as well. The Middle Eastern currencies, one could argue. The euro has overshot, but in terms of the dollar, it not greatly. It's largely an overshoot in terms of its effective rate, where it is overvalued at this stage. The largest undervaluations we concluded were Singapore and Switzerland, and that's despite the fact that we gave them larger current account targets than most countries, to reflect the fact that they have held, well, Switzerland, there are some special factors. Singapore, we don't fully understand, but they have they've traditionally had very large current account surpluses, and we think that in part that's rationally motivated, so we gave them a larger current account balance target, but despite that, they're still the most undervalued of all currencies. The largest overvaluations, on the other hand, South Africa and Turkey. To some extent, Poland also we concluded was overvalued. US neighbors, Canada and Mexico, appear roughly correct. No problems there that we can see. And then I think it's rather interesting to note that Canada and Australia are both close to parity with the US dollar at this stage. That's partly reflecting the strength of primary product prices. They're both big primary product exporters, and assuming that that is going to continue. The Swiss franc, we concluded, ought to be, its fundamental value is greater than that of the US dollar. And then the other thing, the last thing that I want to draw to your attention is that even though there were some very large bilateral appreciations of Asian currencies shown there, they are substantially larger than the effective appreciations. And that's because these countries trade a lot with each other, and therefore when they all go up together, one gets a much smaller adjustment in the effective exchange rate than the change in the nominal exchange rate vis-a-vis the US dollar. Indeed, there are some countries like Korea, which one would require to appreciate against the dollar, even though one wants the effective exchange rate to depreciate, because they're overvalued at this stage. Oh dear. Oops. Yeah. Sorry. I don't terribly like this little gadget, Bill. Let me conclude that the basic picture is very similar to that which we reached in our conference a little over a year ago, the conference that was mentioned earlier, in which also the Bruegel Institute in Belgium, in Europe, and the Korean Economic Policy Institute, Korean International Economic Policy, Institute for International Economic Policy, they cooperated with us. That's to say, the big disequilibrium in the world today we see as being the weakness in some of the Asian currencies, rather than the problem of the dollar being too strong on a general basis has now been resolved. But there is still a serious undervaluation of the RMB and a number of other East Asian currencies, and that in turn means that there is a problem of overvaluation of the effective exchange rate of the dollar, along with the euro and a number of other currencies. And then there's this point that I think it is important to realize that there's going to be a need for bilateral appreciations against the dollar by some currencies that are overvalued on an effective basis. Thank you very much.